Hello, everyone. Good day. So, this lecture video will be all about our discussion on DuPont analysis. So, keep in mind that we are discussing this DuPont analysis in relation to our major topic, which is performance management system. So, as part of um, assessing our performance of the organization, in the previous video, we used balanced scorecard. And then this DuPont analysis is another tool in assessing our performance. So let's begin. So this DuPont analysis focuses on the analysis on the return on equity of a certain organization. So return on equity is a closely watched number among knowledgeable investors. It is a strong measure of how well a company's management creates value for its shareholders. Now, particularly, the return on equity can be used only for stock corporations, okay, because this is only used by shareholders. And when we speak of shareholders, these are the owners of a corporation. Okay, so return on equity here, when in our discussion, pertains to the assessment on the profitability of the equity of a corporation. However, even though return on equity is widely used, this number, the return on equity, can be misleading sometimes. Why? Because it is vulnerable to measures that increase its value while also making the stock riskier. This means that even though there is an increase in return on equity, when you compute return on equity, even though you can see an increase, that might be misleading because it might make you think now you are doing well, the company is doing well. When if you look at the effect on the stocks can be perceived as riskier if you really delve into it. So don't just focus on the number of the return on equity. So without a way of breaking down the return on equity components, investor could be duped into believing a company is a good investment when it's not. So for example, you are a potential investor of that corporation. So you as an investor, you need to be careful also. Um, Before you decide nga mo invest ka ana nga corporation, you need to look at how well the corporation is doing, right? And one way to do it is for you to compute its return on equity. And if you can see that the return on equity is high, then don't just stop there because there are other components that might result to the increase in equity, but in reality, that is actually making the stocks riskier on the shareholders' part. So don't just stop there. Okay, so you need to break down the return on equity components. So how to break down the return on equity? So we can use the DuPont analysis. Okay, we will use DuPont analysis to break apart the return on equity and gain a much better understanding of where movements in return on equity are coming from. Okay, at this point, let's take note that DuPont analysis is a framework for analyzing fundamental performance originally popularized by the DuPont Corporation. So that is why it's called DuPont analysis because it is popularized by DuPont Corporation. This is a useful technique used to decompose the different drivers of return on equity. When we say drivers, we are referring to the factors that we used in the computation of the return on equity. Now, there are two versions of the DuPont analysis. One utilizing decomposing it into 3 steps and another 5 steps. So we will learn the 3 step DuPont analysis and the 5 step DuPont analysis. Now, return on equity on its original na formula, 'di ba? We learned this in our other management accounting subjects when we had the financial statement analysis. Okay, so return on equity is equal to net income over shareholders' equity. So it actually requires only two numbers. You need to know the net income and the shareholders' equity, and then you can get return on equity. Now, if this number goes up, meaning if return on equity increases, it is generally a good sign for the company, as it is showing that the rate of return on the company's equity is rising. The problem is that this number can also increase simply when the company takes on more debt, thereby decreasing shareholders' equity. Now, I have mentioned last time that when we speak of financial structure of a company, now asa man nagikan ang capital sa company, capital in its ordinary meaning, it could be coming from the owners in the form of equity, and it could come from debts or utang, right? The capital. So, if we incur more debts, that means gamay ra nga portion ang equity. So, that might make our return on equity higher. So, if you just look at the return on equity, taas siya, but it doesn't mean that our stocks are becoming more valuable. It could be that nitaas atong return on equity because our debts have also increased. Okay? So this would increase the company's leverage, which could be a good thing, but it will also make the stock riskier. So let's look at the three-step DuPont analysis. So from the original return on equity equation, we will break it down into three components. That is why it is called a three-step DuPont analysis. So again, a more in-depth knowledge of return on equity is necessary to avoid mistaken assumptions. Like here, para dili ta masayo pag-assume nga ni nindot ato ang company when in fact ni taas ra day ang ROE because of the increase in debt, we will now break it down into its simpler components. Now, in the 1920s, the DuPont Corporation created an analysis method that fills this need by breaking down the return on equity into a more complex situation. Okay, DuPont Company is actually one of the earliest and most prolific users of the return on investment criterion. Originally, the DuPont analysis performed by the DuPont Corporation is applied in their computation of return on investment. One of the DuPont's major challenges as an organization that was growing quickly in the late 19th century was to develop a way to manage the complex structure caused by its diverse activities and operations. So at this time, that time, most organizations were single product operations. Usa lang ang ilang product. These organizations approached the evaluation of the investment level of the organization by considering the ratio of profits to sales and the percentage of capacity used. DuPont, however, on the other hand, being a multi-product firm as opposed to most firms nga single product lang, DuPont pioneered the systematic use of return on investment to evaluate the profitability of its different lines of business. So at DuPont, the actual exhibit used to summarize operations was extremely detailed and contained as many as 350 large charts that were updated monthly and permanently displayed in a large chart room in the headquarters building. So the analysis of the return on investment inside the DuPont company is quite complex as compared to what was done by other corporations. So again, initially they used this DuPont analysis in the analysis of their return on investment. Okay? So, di ba unsa kining return on investment? This is net income over the investment. However, if we apply this no to specifically for a corporation, Since the corporation is owned by shareholders, the shareholders will likely compute the firm's return on investment as return on equity. Because when we look at return on investment, we are simply looking at a particular investment. So, for example, a particular product. Example, we have 5 products. So, if you want to know the profitability of that product, product one, for example, you will look at or you will compute the return on equity for that product. However, if you want to look at the profitability of the firm as a whole, dili return on investment ang imong gamiton but rather return on equity. So that is why um ato ang discussion diri will revolve around the computation of the return on equity. So again, as mentioned, there are 2 variants of DuPont analysis, the original 3-step equation and the extended 5-step equation. So let's look at the 3-step DuPont analysis. Again, 3-step man siya because it is composed of 3 things. And what are those? We have NPM, asset turnover, and equity multiplier. So these are the 3 components of ROE under the 3-step DuPont analysis. So return on equity is equal to NPM, which is net profit margin. When we say net profit margin, net, this is already after all deductions, including the deductions for taxes and interest. After deductions for taxes and interest. And then we have asset turnover and then equity multiplier. So let's break it down. How did we arrive at these 3 things? Okay, so from the original ROE equation, a while ago, we mentioned that is net income over shareholders' equity. This one. So just simply multiply the equation by sales over sales. So net income times sales over shareholders' equity times sales. So you will arrive at this formula. So this one, net income over sales, this is our net profit margin. While sales over shareholders' equity, this is our equity turnover ratio. But let's not stop there. Kaya dapat kaniya to ang ma-arrive. Kani silang tulo. So we break it down further. We multiply this equation by assets over assets. Okay, so if you notice, kanina ana tay assets sa numerator and then we also have another assets for the denominator. So this one now gives us the three-step DuPont analysis. So net income over sales, that is our net profit margin. And then sales over assets, mo na siya ato ang asset turnover. And then assets over shareholders equity, that is our equity multiplier. Okay, now if the problem is silent, no, and then the problem asks you to compute the return on equity using the DuPont analysis, then we have to use the 3-step DuPont analysis instead of the extended 5-step. So we have broken down our OE into net profit margin. What is net profit margin? This is how much profit the company gets out of its revenues. And then we have asset turnover. This shows us how effectively the company makes use of its assets. And lastly, we have equity multiplier. This is a measure of how much the company is leveraged. So the usefulness should now be clearer. If you compare this equation to our original ROE equation, which is very simple, net income over shareholders' equity, you cannot pinpoint the exact reason of the either increase or the decrease in the return on equity. So you will not only look at net income and shareholders' equity, you can also look at sales and assets. Okay, so if a company's return on equity goes up due to an increase in net profit margin or asset turnover, so go back here to our equation. If the return on equity daw increases because NPM increases or asset turnover increases, this is a very positive sign for the company. So you have to ask yourselves, unsa man ang nakapa-increase sa return on equity nato? If the reason of the increase is because the net profit margin has increased or the asset turnover has increased, then we can really say that our company is performing very well. It is a positive sign. However, if the equity multiplier is the source of the rise, for example, the two factors remain the same, but equity multiplier has increased, thereby increasing our ROE, that's not that's not a an absolute positive sign. This is making things riskier. Kaya ano gani? Because um here, if you look at the equity multiplier, this will rise, diba? Because equity multiplier is assets over shareholders' equity. This will rise or mo increase siya if the denominator decreases, right? So if the denominator decreases, that means the equity has decreased. This means that our debt has increased. Okay, so if equity decreased, that means our liabilities have increased, thereby increasing the equity multiplier and thereby increasing the return on investment. So that if that is the reason why our ROE has increased, then that means our stocks are being more riskier. Okay? Now, what if the ROE did not change from one period to another? If you compare, let's say, this year's ROE versus the ROE last year, if you see no change at all, does it mean that maura gyud ang position sa atong company? The answer is no. You have to look at the factors here comprising our ROE. Suppose a company releases numbers and ROE is unchanged. Examination using the DuPont analysis could show that both net profit margin and asset turnover decreased. So pwede nga wala change at all sa ROE, but when you look at these components, it could be nga the NPM has decreased or the asset turnover has decreased, but there is a corresponding increase in the equity multiplier, thereby na offset ang iyahang pag-decrease. Maunang, as a result, the ROE remained unchanged. Now, if you look at the decrease in the NPM and the decrease in the asset turnover, that is a negative sign, right? So even if it was eventually offsetted by the corresponding increase in the equity multiplier, thereby showing us an ROE that is not changed, we should consider it as a red flag still. Okay? So dapat you do some changes. Even though your ROE did not change at all, but because of the DuPont analysis that you have performed, you found out that your net profit margin and your asset turnover have decreased. Bisan wala jud na change at all ang ato ang ROE because there is a corresponding increase in the equity multiplier, then you need to do something about it. Okay? Because this would be a bad sign. Kaya ngano gani ang ato ang goal is to if you want your company to be profitable, your net profit margin should increase as well as your asset turnover. Now let's look at the 5-step DuPont. The 5-step or the extended DuPont equation breaks down net profit margin further. From the 3-step equation, we saw that in general, rises in the net profit margin, asset turnover, and the leverage will increase ROE. The five-step equation shows that increases in leverage don't always indicate an increase in ROE. Unsa ganing increase in leverage? Unsay pasabot sa increase in leverage? When the problem says increase in leverage, that means that that is an increase in debt. So if mo increase atong debt, unsa kitong mahitabo sa equity, equity will decrease, thereby increasing our equity multiplier and thereby increasing our ROE. Now here in the five-step DuPont analysis, we will break down the net profit further. So unsa ganito akong gimension ganina, basta net profit, that means all expenses, all deductions have already been taken into account, including taxes and interests. Now, since the numerator of the net profit margin is net income, this can be made into earnings before taxes. Kailangan i-deduct man ang tax, di ba? So, to deduct the tax, you have to multiply the equation. Okay, remember this one in our three-step DuPont analysis, the numerator here should be net income. But this time, let's replace it with earnings before taxes. And in order for us to deduct the effect of taxes, we should multiply the equation with 1 minus TR. TR being your tax rate. And then we break this down further one more time. So instead of earnings before taxes, we can also express the numerator as earnings before interest and taxes. This one, EBIT. Earnings before interest and taxes. And here, this is where we reflect the effect of taxes, and this is where we reflect the interest expense. We deduct interest expense, and here we deduct the effect of taxes. So to simplify this equation, we have this one. So why is it now five-step? Because there are five components in the computation of the return on equity. So we have the operating profit margin. Ang kaning operating profit margin, this is EBIT over sales. Again, EBIT is for earnings before interest and taxes. And then multiplied by our asset turnover ratio or asset turnover minus the interest expense rate times the equity multiplier times the tax retention rate. Now, regardless of which equation you want to use, whether the equation under the original return on equity equation, katong net income over shareholders' equity, or the three-step DuPont analysis, which is ROE is equal to net profit margin times asset turnover times the equity multiplier, or the five-step DuPont analysis, which is this one. We have five components. Regardless of which equation you would like to use in computing ROE, you should be able to arrive at the same amount. Dapat parehas lang og answer ang inyong ROE. So when to use the simple ROE equation, when to use the three-step, when to use the five-step, it will now depend on the given amounts sa ato ang problem. Okay? So if daghan kayo gipanghatag din ha, and then you cannot use immediately the original ROE equation, then you need to look at other equations, either the three-step or the five-step DuPont equation. So both the three and five-step equations provide a deeper understanding of a company's return on equity by examining what is changing in a company rather than looking at one simple ratio. So don't just look at the amount of the ROE. You have to look into the reasons why ingon ana. As always with financial statement ratios, they should be examined against the company's history and its competitors. So, for example, when looking at two peer companies, one may have a lower ROE. So, if you are to compare two companies and then the ROE of the other company is lower, using the five-step equation, you can see the reason why the company's ROE is lower than the other company. It might be because creditors perceive the company as riskier and charge it higher interest. So if the creditors um, decide to charge the other company higher interest, then that means that the company is incurring higher interest expenses, thereby having the effect of lowering the return on equity. Or the company is poorly managed and has leverage that is too low. So if the leverage is too low, that means the equity multiplier is also low. Then if low ang atong equity multiplier, then ROE will also be lower. Or the company has higher costs that decrease its operating profit margin. This also has an effect of lowering the return on investment. So identifying sources like these leads to better knowledge of the company and how it should be valued. So the bottom line, or to sum it all up, a simple calculation of the return on investment may be easy. Easy because you only need two things, di ba? Katong net income and shareholders' equity. And tell quite a bit, but it does not provide the whole picture. If a company's ROE is lower than its peers, the three or five step identities can help show where the company is lagging. So if you are to compare the ROE of a single company to another company, then if you want to know the reason of the differences sa ilang ROE, then you can use the three or five step DuPont equations. And you will be able to point out which part ang cost gyud nganong mas gamay iyang ROE as compared to its other peers. It can also shed light on how a company is lifting or propping up its ROE. DuPont analysis helps significantly broaden understanding of ROE. So let's try one problem. Okay, let me just open a Jamboard. You can see this yet, right? Okay, I think I need to share a window. How can I share this for a while, guys? Okay, there. Okay, I hope you can see it now. Okay, so here. Example, a firm has a profit margin, not profit margin of 3%. So let's write it here. Net profit margin of 3%. And then an equity multiplier of 1.9. Equity multiplier of 1.9. And then sales of 150 million. while its total assets 60 million. Now the question is, what is its ROE? What is its ROE? Right. So here we can use the three-step DuPont analysis. So ROE is equal to net profit margin times asset turnover times the equity multiplier. Now next question is, do we have an NPM here? We have, which is 3%. Do we have asset turnover? Wala. Do we have equity multiplier? Yes, we have. So let's just break asset turnover down. So 80 is, we have sales over assets. Okay, so let's try another color. ROE is equal to net profit margin, which is 3%. Let's just convert that into decimal. That's 0.03 times asset turnover, which is sales over assets. So here we have sales of 150 million and then over total assets of 60 million times the equity multiplier of 1.9. So this becomes 0.03 times, that's 150 over 60, 2.5 times the equity multiplier of 1.9. So 0.03 times 2.5 times 1.9. You have 0.1425. Or in percentage, we can express this as 14, kaya rin na lang sa babaw. 14.25%. Now, in my future examinations or quizzes ninyo, if I say nga you should express your answer into decimal points, then you should answer this way, 0.1425. But if I specifically require you to express your answers in percentage form, then you should answer this way. And I will also indicate how many decimal points ang inyong i-include. Okay, so as simple as that. Now, there might be problems that would ask you not ROE. For example, some problems might give you already ROE. Let's say ROE is 14.25%. Then asset turnover is this much. Equity multiplier is this much. So how much is the net income of the company? So you can actually compute that by breaking down the net profit margin, right? Because this is net income over sales. So by using the other um, given numbers here, figures, you can compute for net income. So dili all the time nga sa problem ROE ang pangitaon. So uban problems nga net income ang i-require, sales, equity baron, or assets. Okay? So just play around with the three-step DuPont analysis. Okay, and then after watching this video, look at your canvas. You can see there your quiz for the DuPont analysis. Make sure to answer them within the day. Thank you.